has reported its Q4 earning and the market reacted positively to it because Q4 numbers were higher than what analysts estimated. Profit reaching 13,718 crore rupees with the revenue hitting 70,698 crore rupees. However, the real picture lies in transition. Q4 is very profitable with operating margin of 4-year high, that is 25.3%. But the full picture shows that the constant currency revenue declined by 2.4%. TCS is navigating low growth macroeconomic environment, but they are doing it by signing AI deals and aggressively optimizing on costs. Let's have a look at Q4, which is their strongest quarter. So first is revenue, which grew 9.6% year on year. The net profit grew 12.2% year on year. They have a sequential growth, which is that they have growth of revenue 5.4% comparatively to previous quarter. And this is important because they have reported 3 consecutive sequential growth, which means it is not because of a particular reason, but company is consecutively growing. Then they have signed 3 mega deals in Q4 quarter, for which $12 billion is the total contract value. Now this is the most important point where most retail investors get confused. So TCS has reported their revenue in INR grew by 4.6%. However, their constant currency revenue declined by 2.4%. But what does constant currency mean? See, companies like TCS earns majorly in dollar and euro. But now that rupee has depreciated, they are stripping away the exchange rate benefit. 0.4% decline reveals that their actual volume of business and software contracts have contracted this year. And this is majorly because banking sector has contracted their IT budgets. To understand where the money comes from, let's have a look at their segments. First is BFSI, which is their strongest segment, driving 31.9% of revenues. Bank had a tough year, but TCS management are expecting it to normalize by financial year 2027. North America remains the heavyweight by bringing 50% of the revenue, followed by Europe, that is 30%. But there is one vital health metrics that we need to check, that is customer stickiness. And they have expanded their wallet share with 2 vital clients for $100 million plus. Now, this proves that they have high customer retention even in the tough times. So which means that if a client is using TCS, their switching cost is too high that they definitely stick with TCS. This is profit margins. So expanding your profit margins when overall business of volume is shrinking requires operational efficiency. And they are doing it on 2 major levers. First is headcount optimization. So the total workforce fell by 3.7%. And second is subcontracting costs. So they optimized and scaled back expensive third-party delivery capacities. But what we need to note is that the CFO has said that in financial year 2027, the increment season that is going to start in April is going to reduce the profit margin by 150 to 200 points for the first quarter. So what company will be earning next year? We need to have a look at order book value.